Today, let's talk about those enticing 5-unit conversions that more and more investors are talking about lately. They offer great potential for more financing options because 5+ units are now in the commercial real estate space. But here's the catch. You can't do this everywhere in Canada. Thankfully, in Toronto, this is allowed on all residential lots. And on top of this, there is more than one way to transform a property into 5 units. So, what factors should you weigh in, and which investment route might be best for you? Well, stick around and I'll dive into all of these details in this video. If you're new here, we're all about helping you make better real estate investing choices in Toronto. Don't forget to like and subscribe if you enjoy our content. Now let's dive in. Are you wondering why 5 units in Toronto are such a hot topic lately? Well, here's the lowdown. Unlike many other cities in Canada where you're typically just limited to 1 or 2, or in Ontario, 3 units, usually 2 in the main house and 1 in the backyard, Toronto has given the green light to go for 5 units on any lot. 4 as of right in the main house, plus a laneway or garden suite in the backyard. Now, over the past year, there's been a lot more interesting game-changing developments. Parking requirements are now waived for new units. And not just that, development charges for the first 4 units waived as well. Development charges for the backyard house deferred. So it's pretty safe to say that the feasibility and the math are also looking a lot better lately. And once you hit 5 units, you can qualify for commercial financing. And the most interesting one these days is the CMHC MLI Select mortgage program, where you can get some of the best financing conditions out there, like lower interest rates, longer amortization periods, and impressive loan-to-value ratios up to 95%. Now, this is looking especially attractive for real estate investors who are looking to scale aggressively because qualifications for this mortgage isn't based on your personal income, but rather the property's financials instead, which means that as long as you have an investment with strong cash flows, you can continue to borrow money and do this again and again. Now, I won't dive too deep into the MLI Select program in this video, but if you are curious to learn more, you can check out this other video right here where I really break things down for you. But just purely based on the benefits I just mentioned, the MLI Select program is already a great financing option if you hit 5 units. But in today's market conditions, it's looking even more appealing, and here's why. For one, these days we are still seeing stable and high cap rates, but fixed mortgage rates are dropping pretty quickly. So what this means is that it's improving cash flows quite substantially over the past few months. And because the MLI Select lends you based on how strong your cash flows are, we are seeing pretty good improvements on loan ratios in the past few months. Now, secondly, we are sensing that the market might be bottoming out, but realistically, there's still a pretty bumpy ride back up. So in this more volatile market today, it just makes more sense to use rental income and math for more reliable valuations post-build, as opposed to relying on market valuations, which can really swing a lot more drastically. And in the case where the market is in a downturn, you can potentially get undervalued properties at the time that you finish your project. Now, if you are seriously thinking about diving into creating 5+ units, there's actually many ways to get this done in Toronto. So, what should you do? Well, let's break down your main options. The first option is to convert a big existing house into more units. In this case, it is cheaper to start with, but keep in mind that you might end up with smaller units and lower rents. The other main option would be to buy a house just purely for land value and then rebuild a multiplex on it. In this other case, it would take more time and more money up front, but you can design it to maximize your rentable space and potentially earn more income because of that. Now, we know that we can have 4 units in the main house as of right, and development charges are waived for the first 4. Now, the next question might be, what should you do with the 5th unit? Well, the most straightforward option would be to build the laneway house or the garden suite in the backyard, and this would cost you around $400,000 for a 1,000 square foot 3-bedroom house. The upside here is that you can potentially rent it out for a good penny, around $3,500 per month. But the other option could be to incorporate the fifth unit right in the main house, providing that your zoning allows for it. Now, if you wanted to do this, you'd want to focus on properties near to downtown because it is more permissive depending on zoning, or maybe even major streets down the line since the city's next priority project is on the major street study where you can potentially build up to 30 units on all major streets. Now, this option would be less expensive to build compared to the backyard house if you're looking at just one extra unit, but you will have to fork out development charges at this point for the fifth unit. And then once it's done, you might end up getting less rent compared to the backyard house. So just talking it all out, it is tough to figure out which option gives you the best ROI. And I think we'd really need to crunch the numbers on each specific project to see which one ends up giving you the best lift and loan ratios once the project is done. Now, here's another thing. Your decision could also totally shift based on the amount of capital you have on hand and your borrowing capacity. So instead of just talking this all out in theory, let's dive into some real world examples. We've crunched the numbers here based on a few options we have on hand for purchase price, expected construction costs, and extra costs like holding costs and government charges. Now check this out. If your capital ends up being more limited, honestly, it's still massive but lower for the scale of the project that we're talking about, but you do have more borrowing capacity, then converting a large existing house into 5 units could be your only choice because it costs the least. What happens here is that even if you factor in a development charge for the fifth unit, it still comes in a lot less. But just keep in mind, because you're converting the existing house into more units, you won't be able to maximize the rentable square footage as much as a new build, and you end up getting a smaller valuation because of that and lower value add, which ends up giving you the lowest loan ratios or LTCs once the project is done. Now, if you've got access to more capital for the project up front, since you need to qualify for this initially with a residential mortgage and your own income, a hybrid version of a main house conversion and building the ADU in the backyard could end up being a better option for you. The main reason here is because the rent yields on the ADU ends up being much better than a fifth unit in the main house converted. So what happens here is that you can substantially bump up your loan ratios on completion compared to the first option once you refinance with the MLI Select. But if you're looking to really maximize your loan ratios on completion, the builds are still the way to go. Now, the argument between creating the fifth unit in a purpose-built 5-plex or creating a 4-plex plus ADU ends up being more of a coin toss because both are purpose-built to maximize rent yields. You end up paying more in fixed costs with the ADU, but you save on development charges. So in the end, they are both good options. If you invest more capital in the project, it seems like you end up getting more cash out, and the LTCs are honestly pretty similar. Now, if you're looking to dive into the world of 5-unit conversions or builds in Toronto, you're in luck because our real estate sales brokerage is your best starting point. Lately, we've been guiding more and more clients through this process of buying and converting, giving us valuable insights into maximizing ROI and minimizing your risks and constraints. But hey, we're not just there to help you buy and then we go away. We actually go the extra mile by helping you plan out your project, connecting you with our trusted network of trades, and we're always around for ongoing guidance and support as you manage your construction project. So if you want to discuss your private real estate situation with us, just head over to this link to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.